Why do contango and backwardation matter for commodity indexes? Imagine trying to predict the future prices of goods like oil or wheat. It's not always straightforward because market conditions change constantly. When you invest in a commodity index, you're not buying the physical goods directly. Instead, you're investing in futures contracts, which are agreements to buy or sell commodities at a set price in the future. These futures contracts can be in a state called contango or backwardation, and understanding these states is key to knowing how your investment will perform. Contango happens when futures prices are higher than the current spot price. This often occurs because of storage costs, insurance, and financing fees that add to the price of future contracts. Investors see this as a sign that prices are expected to rise, but for commodity indexes, it can cause a problem called negative roll yield. When the index rolls over contracts, it sells the near-expiring, lower-priced contract and buys a more expensive, longer-term contract. This process can eat into returns because you're effectively paying more for the future than the current market value. On the other hand, backwardation is when futures prices are lower than the current spot price. This usually signals tight supply or high immediate demand. In this case, the index sells the higher-priced, near-term contract and buys a cheaper, longer-term one. This can lead to positive roll yield, which can boost the overall returns of the investment. So, in backwardation, the process of rolling over contracts can actually work in your favor. The reason these market conditions matter is because they directly influence the total return of a commodity index. Since indexes don't hold physical commodities but futures contracts, the state of the market impacts how much money you make or lose over time. When the market is in contango, your returns might be reduced because of the negative roll yield. When it's in backwardation, your returns can be enhanced due to positive roll yield. Different commodities tend to experience these conditions more often. Energy commodities like crude oil often stay in contango because of storage costs. Agricultural commodities might switch between contango and backwardation depending on seasonal supply and demand. Knowing these patterns helps investors choose the right commodity index that aligns with their risk, comfort, and investment goals. In short, contango and backwardation are not just market terms. They are essential factors that influence how much you earn from commodity investments. They affect the costs and benefits of rolling futures contracts, which makes understanding these market states vital for anyone looking to invest wisely in commodities. Recognizing these patterns helps you better gauge the potential risks and rewards of your investment in commodity indexes.